In this month, we are going to understand the chapter of institutional order flow signatures. What I want you to understand is that this chapter is one of the most important when it comes to how I trade, when it comes to how I operate as a trader inside of the markets. But this chapter, it is linked to our premise that we're going to anticipate the market on a weekly chart and on a daily chart. Everything that we're going to discuss is going to always be linked to a higher time frame premise, because that higher time frame premise is going to give us the confidence to look for a one-sided market. So every singular thing that we're going to talk about in this mentorship is linked to that, but we're going to go in detail when we go through the introduction. And I just want to state that every video that I'm going to do for this mentorship, it is not going to be fast-paced. It is going to be very slow-paced, because this is exactly how I learned the concepts that I trade, and you put your trust in me. So I want to completely deliver everything that I know. And this takes time, and this takes effort, and this is the reality. So, inside of the institutional order flow signatures chapter, the first thing we're going to talk about is going to be the order block. So the lessons that we're going to use in this teaching are going to be the following: the smart money paradigm, which is the pairing of liquidity pools along with rebalancing and imbalance. So understanding the fact that the market only goes higher or lower only for liquidity pools, only to attack or neutralize or induce a liquidity pool, and also only to rebalance an imbalance or an inefficiency. So this is the smart money paradigm. The weekly bias plus narrative, which is the root of intraday trading excellence. The weekly range expansion, correlated with the high impact news drivers, which is understanding the AMD logic. So we have our bias to the upside. We understand, for an example, we have our bias to the upside. We anticipate the market to go higher. And then we see inside of the high impact news drivers that we have some news event. Then we're going to understand that the weekly range is going to expand only in XYZ days, and inside of the first days or inside of some specific days, we're going to accumulate and manipulate. So we are going to filter out these days. We're also going to need the understanding of structural elements, which is going to be the intermediate term high, intermediate term low, balanced price ranges, and these type of elements when it comes to market structure. And then the lesson we are going to go in detail about today are going to be PDRAs, which are which are linked to institutional order flow signatures inside of a bias plus narrative. The smart money paradigm, and I'm going to do a quick recap of this because perhaps you might have not internalized the definition. Perhaps you do not remember why this is important. The definition is as follows: the smart money paradigm is the awareness of how retail-minded individuals operate, so we can capitalize on their stop losses by accumulating positions, using their stops, and profiting off the opposing stops. That is the definition of smart money paradigm. And to make it shorter, we have the awareness that these people don't. We understand how the market really moves, whereas these people, they're deluded by these concepts that they think they're concepts, when in reality they're not. The importance of this lesson, and this is what I wrote down, the importance of this concept is because it's heavily integrated. So we're using it because it's heavily integrated in understanding the AMD concept, where the accumulation is made for the purpose of accumulating retail orders. The manipulation is used to induce them in the wrong direction, and the distribution to profit off their unawareness. So we understand that the market has to accumulate. The market has to do a consolidation. So we have both buy side and sell side liquidity pools. The market is going to manipulate to the downside or to the upside. And then we're going to, that is the position of our accumulation. And then we're going to distribute our profits inside of the opposing liquidity pool. So by the way, you can also right now see how everything is just correlated. Every singular concept is correlated. Okay? Weekly bias narrative, quick recap. Definition. The weekly bias is the most probable direction in which the market is heading on a weekly chart, derived by using a seasonal tendency plus the institutional order flow signatures, along with structural elements to build our narrative, which either confirms or denies our direction. The importance of the weekly bias and narrative is that the weekly bias plus narrative is highly important in determining the weekly range expansion for intraday excellence in determining the daily bias. So when we have the weekly bias to the upside, and then we understand that the market does not have to go into some level, then we're going to understand, number one, the direction for each day of the week, because I've told you that it is correlated with the weekly range expansion. So we're going to understand which days we want to trade based on the weekly bias, and then we're going to have the why. We're going to have the story of why should the market go to the upside and why should the market not go any lower than this. The next one is going to be the weekly range expansion, which is again correlated with the weekly bias and the weekly narrative, or the weekly bias narrative. The weekly range expansion, accumulation, manipulation, distribution, plus high impact news driver. Definition. The weekly range expansion, based on the weekly bias, is determined by the high impact news driver rule sets correlated with the accumulation, manipulation, and distribution concept. So we have the weekly bias again to the upside. Let's just say, for instance, the market is prone to go to the upside for the next week. Then we're going to understand that the market has to accumulate orders on a weekly basis. It has to manipulate those orders, and then we have to offset distribute our profits. So when do we do that? And that is when the high impact news drivers come into play. The high impact news drivers come into play to understand when we do the things that we do. So the importance is as follows. The reason why determining where the manipulation occurs is important is to filter out the weekly manipulation to only trade in the highest probable direction, determining the best days to trade as a result. Exactly how I explained prior to reading the importance. These structural elements are as follows. The definition is that the ICT market structure is defined by identifying the correct highs and lows that are out to stay in place. That is why we use the market structure. That is why this concept is highly important. But I'm just going to also read the importance of why we use a market structure or ICT market structure. The importance. The reason why correct identification of market structure is highly important is because it gives us understanding of where the market is likely to trade and where we should not see the market go, giving us either a confirmation of our bias or a negation. So we have the bias and narrative on a higher time frame chart, and then we have the structural elements, and we also have the weekly range expansion if we want to excel in intraday trading. And then we're going to have the PD raise plus institutional order flow signatures of said PD raise. The ICT PD raise are the concepts used to either confirm a bias and narrative or negate it using the institutional order flow signatures. And this is the lesson that we're going to go in depth about today. The ICT PD raise they're more complex than this, but they're just derived from these two PD raise. So we have the order blocks, which are either a standard order block, we can also have a breaker, we're going to have a mitigation block and also a propulsion block. And we also have the fair value gaps, which are the buy side imbalance, sell side inefficiency, the CB, which is the sell side imbalance, buy side inefficiency, the inversion gap, the measuring gap, and the breakaway gap. The big class, the big base of the PD raise are all based on the basis of every PD raise, every singular ICT PD raise is either an order block or a fair value gap. So we have multiple order blocks, which we're going to look at, and then we also have multiple fair value gaps. In this lesson, because I want you to focus slowly and I want you to get the highest quality of mentorship, we are going to focus on order blocks. But I'm also going to give you the definition of institutional order flow signatures, why we use them, why we care about them, and how we use them. So the definition and usability. Institutional order flow signatures are directly linked to a predetermined bias, where we use them to either confirm our bias or negate it. A key understanding for this lesson is that the wicks do the damage and the bodies tell the story. So when we're going to look for institutional order flow signatures, we are also going to understand that the market is going to trade inside of a level, and that is going to negate or confirm my direction. However, most of the focus when we are building the narrative, when we are building the story, is going to be on the bodies, because the wicks, their responsibility is for the wicks. Their responsibility is to do the damage, and the bodies tell the story. And an attention point that I wanted to emphasize inside of this current explanation is that what most ICT traders fail to realize, based on the rule set of the 3 failing PD raise, is that you can anticipate or predict the opposing PD arrays to fail, therefore turning them into either inversion levels or targets. I'm going to quickly go through this so you understand what this means. So when we're going to look for the market to go to the upside, we are never going to want to see 3 failing PD arrays. So if the market does a signature that tells me that the first PD array, which can be a fair value gap, the first PD array has failed, then I'm going to understand that I'm going to look for the next PD array to reject price higher. If the second PD array has also failed, then the last line of defense for my idea would be the third PD array. And if the third PD array fails, then instead of my bullish bias, this is going to be a negation. And this is the standard thing that every ICD trader understands, or every trader that genuinely studied ICD understands. But the thing that I want you to understand is that when you're going to look for a higher bias, when you're going to look for the market to go to the upside, you can also anticipate these opposing inversion fair value gaps, or these opposing SIBIs, or these opposing PD arrays. You can absolutely anticipate them to fail for a confirmation of your bias. So you can use this rule set in both ways. So, as my videos or the mentorship videos are non-edited, I'm going to quickly drink some water, and then we're going to go into the ICD order block. So the ICD bullish order block, I'm going to frame everything into a bullish narrative, into a bullish stance. So we're going to have bullish breakers, we're going to have bullish mitigation blocks, we're going to have bullish propulsion blocks, but everything is going to be bullish, but everything is also the same when it comes to bearish order blocks and all that stuff. So everything applies, but I do not want to waste your time. So we're going to, you're just going to invert the rule sets for a bearish narrative. So the ICD order block, the definition of an ICD order block. An ICD order block, or an ICD bullish order block, is a change in the state of delivery where the market delivers in the opposing direction of the current trading order flow. So if we're going to look at the market and we're going to see that the market is indeed going to the upside, so the market is delivering on a buy side direction, so the market is delivering buy side delivery, the change in the state of delivery is going to be named as a means of bullish order block. A bullish order block inside of a bullish institutional order flow has the duty to completely reject price higher, and it should always support price during an expansional phase. So therefore, if we're going to look for the market to expand higher, then what I anticipate this order block to do when the market comes back into it is for the market to quickly reject it and for the market to go higher. This order block is the concept that is correlated with the expansional side. So when we're going to look at whether the market is consolidating, the market is expanding, or the market is retracing or reversing, this concept, the order block, is correlated with an expansion. So when we're going to look for an expanding market, the bullish order block or the bearish order block is going to be the concept which we're going to choose. These sensitive price points for a bullish order block and their inverted for a bearish order block are as follows: the order block high, the order block wick consequent encroachment, the order block opening price, and the order block mean threshold. How do we know that the market has indeed created an order block? And how does one order block create? Does the market have to close above it? Does the market have to only go above it? How do we know? Inside of a bullish scenario, the order block is confirmed through the market trading, not closing, trading above its high. So when the market only trades above the down close candle that is going to be an order block, then this confirms the order block and this forms the order block. So we do not need any closure above the order block. We just need the market to go above it, and this confirms our order block. Moving on into order block rule sets. The first thing we're going to look at is going to be the big wick order block. The sensitive price points of a big wick order block are going to be as follows. We're going to have the order block high, which is going to be a sensitive price point, and we're also going to have the order block wick consequent encroachment. So, inside of a big wick order block, while the opening price and mean threshold are allowed, and the mean threshold is just the 50% of an order block, we prefer to only see the wick high and the consequent encroachment of said wick, and we want to see the market close above it. So therefore, when we have a big wick order block, that is what we want to see. A closure below the consequent encroachment of the wick would be the first sign of negation of a premise and of our premise, and it is not favorable for continuation. So, if the market closes below the consequent encroachment of this wick, this would be the first sign of the negation of the bullish narrative that we would have in this instance. So if we're going to look at a big wick order block. For a small wick order block, we're going to look for the opening price and the mean threshold. So, inside of a small wick order block, what we want to see is we want to see the market reject the opening and we allow for it to trade into the mean threshold. And the reason why trade is underlined is because we never want to see the mean threshold being closed below, which is exactly what I wrote below, which is, however, the rejection from the mean threshold should be immediate. And if we see the market close below it, then it means that our bullish bias was invalidated, and what we're going to do is we're going to stay sidelined. The next one we're going to talk about is the propulsion block. So the ICD propulsion block definition. The ICD propulsion block is a specific order block trading down into, in a bullish example, into another order block. So if we're going to look at this depiction, we're going to have the first order block, then the market created this order block by running above it, and then we have another order block coming back into the opening price or the mean threshold of this small wick order block. And after the market leaves or confirms this propulsion block, then because the ICD propulsion block is a signature of strength and we want immediate feedback, feedback to the upside with speed. So this is a sign of strength. And these sensitive price points for this propulsion block are going to be the propulsion block high and the propulsion block opening price. We never, when we're going to look for a high movement to the upside, a speed movement to the upside, we are never going to want to see either the high or the opening price violated. We never, inside of a propulsion block, we never want to see the mean threshold, because this is, again, a sign of strength. And as a bonus point, the ICD propulsion block is usually followed by a breakaway gap, given it's an important sign of strength in an already pre-existent bias higher. So this order block is most of the time responsible for the breakaway gap that is going to form after it. Why do we care? Because if the market reaches down into the mean threshold of this bullish order block, it is invalidated and the market denied our scenario. So if the market reaches back and it wants to go back to this mean threshold, then our scenario is invalidated. And instead of a higher time frame, for example the daily chart, knowing that we have formed a propulsion block correlated with a higher bullish narrative, what we can do is we can easily predict an explosive movement the following day. So if we see the market creating a propulsion block, then what we can do is we can anticipate, after the market has successfully created this propulsion block, we can successfully anticipate that the next day is going to be explosive. Inside of a higher time frame daily chart, we can also get insight on where the low of the day should be formed, given we only want the high along with the opening. What this means is, if we're going to trade inside of this candlestick or a candlestick that goes back to this propulsion block, we know, based on a rule set, that the market should not go into the 50%, the 75%, or the opening price. It has to only reject the opening price. And we never, inside of a lower time frame chart, want to see the market go back below the opening price, close below it, because this would mean that the market is going to reach for the mean threshold, which we do not want to see. And if the market indeed reaches into the 50% of the order block, then this is invalidated, and it means that the market is going to go for this low, for this 50%, and for this low, and then for this ones. The ICD breaker block. Definition: the last up close candle prior to a sell stop run, followed by a run and closure above it, is a breaker block, or a breaker order block, I wanted to say. So the reason why I did this with a line is because this is somewhat of a pattern, so it is not something that you can see easily when it comes to, you can see it easily, but for this example, this is much easier to understand what a breaker block is, or a breaker. And the breaker is basically just the last up close candle prior to the market going back and manipulating some level of opposing stops. So if you are looking for a bullish run, then the opposing stops would be the level of sell side. So the up close candle that does this manipulation leg, or the up close candle that starts this manipulation leg, is the breaker block. And the breaker has to be followed then by a run above the breaker block. So the logic is the candlestick that initiated the run into the stops, where the market, where smart money accumulated longs below retail sell stops. So this candlestick here initiated this one, and this is where smart money accumulated stops, because we have this level of sell side where the retail stops are residing. So this is the candlestick that initiated this run, along with inducing new shorts by means of a breakout, followed by a run above. So when retail traders are going to look at this movement, and there are retail traders that use breakout strategies, what they will want to do is they will want to go short because this low was broken. So this is why we also induce new shorts and we neutralize the existing sell stops, the existing people that were indeed correct, but they have their stop loss either trailed here or they have their stop loss here as their new position. And therefore, we will use the breaker and favor it against the discount run. So if you have this dealing range from the low up into the high, we will favor the breaker because we never want to see the market give these people an opportunity to mitigate their losses. So these people here, they are trapped retail sell stops. We never want the market to go back into a discount because these people, they are now highly emotional. And what they will do is they will take out their positions, and we never want to do that as smart money. The breaker block has the following sensitive price points. The breaker high, which is the most probable, the breaker mean threshold, and the breaker low, which we most of the times prefer not to see. A key signature inside of the understanding of the ICD breaker block is that the ICD breaker block, understanding its usage as the market is trading with velocity and distance, giving the logic of the breaker, is preferred to reject price higher only through its upper half, it representing a sign of strength, and a run into its lower half reduces its probabilities. The reason why we only want to see the upper half of this breaker is mainly because we have the understanding that we have trapped all of these people here and we went above the level of buy side, and we never want to see these people mitigate the losses or go out at a lower loss. Attention. Like every singular ICD PDRA, if the breaker is seen on a higher time frame, which is monthly, weekly, and daily, it's 25%, 50%, and 75%, and both low and the high can be used as a means of support in a bullish environment or resistance in a bearish environment. So if we would have this breaker block on a higher time frame chart, so this would be a daily chart, if we're going to look at the 50-minute chart, and if we want to see the market go on a target above here, then we're going to use the 25%, the 50%, and the 75% as means of support when the market closes above them. And as a bonus, these breakers can be used as standard deviations projecting the entire dealing range. So from the standard deviation, from the breaker low up to the breaker high, these can be used as a means of standard deviation. And I'm going to show you an example where I did this. And the mitigation block is relatively similar to the breaker, having therefore the same rule sets. And one more thing that I want to say inside of the breaker is confirmed when the market closes above the breaker. So the market has to close above the breaker. This is the only time in which the market has to closes above an order block, where we confirm it by closing above it. And same goes for the mitigation block. And the mitigation block is mainly just the market not taking out this low and just doing a retracement back into this fair value gap here, or whatever PWA is here. And we will use this as the market has now done the job to rebalance this imbalance, and we have a balanced price range yielding range. And this is for another discussion. And this would be a highly detailed example of everything that we talked about. So this is exactly our model. The 950 to 1010 macro entry, the 50-minute previous session sell side being taken, the 1-minute market structure shift inside of the 950 to 1010, and everything is seen right here. So the market has successfully manipulated to the downside. This is the pre-market CPA sell side. So the people that would have their stop losses here below the induced movement of the CPI at 830. So we took all of these people lows, or we took these lows because there were people that would have their stop losses here. This is where smart money accumulates. And then we're waiting for the market to do a market structure shift between 950 and 1010. This is where it happens. So therefore, our breaker that we're going to use as a means of standard deviation is going to be these up close candles prior to the movement to the downside. When the market is going to expand higher, what we're going to want to see is an order block here being rejected to the upside. The market never goes back into this, so this is a sign of strength, but this would be a mitigation block here. Market goes back into the mitigation block. Notice the bodies of the candles. And then once the market moves here, propulsion block, because it's an order block that goes back into the order block, and then we have a breakaway gap, which is exactly the characteristics of this propulsion block. And then the market closes above the breaker. Here, the market retraces back into the breaker high, and then we continue to the upside. Fair value gap, and we hit our objective, followed by the market trading back into an order block. You can see how the market uses the mean threshold beautifully here. It quickly rejects it, and then we go into the breaker standard deviation. So this is the teaching. These are the rule sets of the order blocks, of the breakers, and I hope you enjoyed this one, and I'll see you in the next one. Peace.